There is one defensive interval ratio. What does defensive interval ratio tell? See, this ratio tells us whether you have enough cash to meet your daily expenditure or not. So, defensive interval ratio is another measure of liquidity that indicates the number of days of average cash expenditures the firm could pay with its current liquid assets. That means it shows how many days expenditure you can easily pay with the help of the cash, the cash or the current assets, whatever you have. Okay. So let's say if you have 1 lakh rupees worth of current assets and the average daily expenditure is 10,000. So you have 10 times the capacity to meet your expenses. What do you have? Come on, tell me. You have 10 times the capacity to meet your expenses. If I have to see it in terms of days, so I have 36.5 days worth of, I have funds with which I can meet 36 days worth of expenses. Okay, because I have done this, right? That means I really have around, you know, so that's what the ratio said. Like number of days of average cash expenditures the firm could pay with its current liquid assets. So we said that we saw that we have 100,000 worth of cash and securities, and the average daily expenditures is 10,000. So we have 10 times the capacity. When I converted that into days, I saw around 36 days expenses I can easily meet. Okay, if I have 1 lakh rupees worth of cash. So how it goes, that too I'm speaking about year, in a particular year. Okay, in a particular year. So 36.5 days ka expenses I have. So I spent 10,000 or this much expenses I spent in these days. For that also I have the reserves. Then again next 36.5 days again I spent 10,000. In that way I have 1 year's expenses with me. Okay. So that is good for the company if they maintain this kind of ratio. Now comes cash conversion cycle. So I will give you a very good formula for this. Cash conversion cycle is nothing but debt collection period plus stock conversion period minus debt payment period. That means how many days it takes for you to bring the goods from your supplier, sell it in the market. The sales can be cash sales as well as credit sales. Let's say it takes 100 days. Let's say it takes 50 days for you to collect your money from your customers, and it takes 100 days for you to convert your stock into cash. Let's say Jan 1st you started your business activity, you were able to sell some X amount of goods. Then again Jan 2nd you were not able to sell goods. Jan 3rd you were able to sell Y amount of goods in that Y amount of goods. Okay, Jan 4th you sold some X amount of goods on cash and Y amount of goods on credit. So there can be cash sales, there can be credit sales. Okay, so if it is cash sales, immediately you get money in your hands. If it is credit sales, it goes under debt collection period category because receivables are created. In that way 50 days it will take for you to collect your money from your customers. 100 days in total it will take for your inventory to convert into cash, and then 60 days you take to make the payment to your suppliers. So what does cash conversion cycle say? How much time it took for you to collect your money from customers, convert your inventory into cash, and then again make the payment to your suppliers. So all in all, that was the period whereby the cash was always in circulation. Okay, or that was the time period, the resultant time period. 150 minus 60 is how much? 90 days. So 90 days is the time period in which you converted your receivables, inventory into cash and also made the payment to your suppliers, right? Please make a note of this. one thing I would like to tell you, cash conversion cycle should not be for longer term or long period. A high cash conversion cycle is not good for the company. A short cash conversion cycle is good for the company because it shows very faster, like very faster, like conversion of inventory and receivables into cash, as well as the payments are made very faster. Let's say a cash conversion cycle of 50 if I have, that is better than 90 because 50 days was the time period in which I collected all my like money from customers. I converted my stock into cash and also I made the payment to my suppliers. So this was a time period whereby all this happened, the resultant time period. If it is less, that shows faster, faster movement of cash. That means more faster you are able to collect your money and more faster you're able to make your payments. Okay. Here, the collection of money, the conversion of inventory into cash and the payment is taking lot of time. Here it is taking very less time. So the business is moving very fast. It is good for us, right? It is very desirable for any business. Now, so we are done with this entire topic, financial ratios 1, part 1. We are moving into financial ratios 2, but before going into that, we will go for this particular ratio, working capital turnover. So what is the formula for working capital turnover ratio? Wherever I speak about turnover, revenue comes into picture. So let's say my revenue is 1 lakh and average working capital I'm maintaining 10,000 in my business. So I have, you know, for $1 investment in working capital, I am able to generate $10 of revenue. Okay. If for $1 investment of working capital, I am able to generate $12 of revenue, that is better than generating $10 of revenue. So if this is, with less amount, more revenue if I generate, that is always desirable. Okay. $1 to $1 investment in working capital gives me $12 of revenue. $1 investment in working capital gives me $10 of revenue. Which is better? I want the answer in chorus.
So
I'm
first,
asking. That's what. This is always better, right? Now. So all these ratios help us to understand the performance of company in various areas. Like for an investment of $1 in the working capital, how much revenues they are able to generate, right? That shows the operative efficiency of the business. Now we are entering into the next set of ratio, debt to equity ratio. This comes under solvency ratio. Okay. What do you mean by debt to equity ratio? It shows the relationship or the ratio of debt and total shareholders equity. So let's say my company's debt is $1 million and my shareholders equity is also $1 million. Okay. The ratio is 1:1, right? I'm asking you a question. How much is the desirable debt to equity ratio? So see, any business, it's okay. Like if they go for like in many of the books which I have taught in the previous past, 2:1 is the ideal debt to equity ratio. What we have seen in the previous past, more than 2:1 is not desirable for any company. But if the ratio goes to this, it shows more reliance of the company on debt. Debt is not dangerous for the business. You should understand. Without taking debt, you cannot become richer. If you want to buy a house, if you don't have resources, you will definitely take loan. If you don't buy assets on time, in future it will become very costly and it will be out of your reach. So on right time, right decision has to be taken. Debt is never a bad thing for the business, but it's a risky thing. That too, if taken beyond certain limits. 1:1 is an ideal ratio. 2:1 is to some extent is acceptable. If it is 4:1, that means your debt is way higher than equity. That is not acceptable. If your business is not performing well, then your business can go into bankruptcy as well. Why? Because a very higher debt to equity ratio is dangerous for the business, because you are taking very high amounts of debt, which is not desirable for a business, because it puts ultimately the pressure on shareholders. You have to pay very high amount of interest, and consistently you have to perform. Consistently you have to perform, and you should ensure that your business is always into profits. Otherwise, paying that fixed interest amount becomes a very big burden. You can take leverage or advantage of fixed interest cost, but only if you have what? Higher profits. Did you understand? Or higher revenues. If your revenues are dipping, then you cannot take advantage of that fixed cost. Okay. See, can you give me an example, like how I can take advantage of fixed cost with higher revenues? Any one of you? Hello.
Sir, tax benefit.
Sorry.
Interest benefit will be claimed, no, sir?
No, no. See, understand. Sales minus variable cost, contribution. Contribution is nothing but excess of revenue over variable cost. Let's say I'm making 100 units and I make 200 units. My activity level is double. Okay. And sales is 1 lakh. Variable cost is 40,000. Contribution is 60,000. Minus fixed cost. Fixed cost I'm taking 10,000. 50,000 is my profits. Okay. Here my fixed, I don't have any fixed operating cost. I only have fixed finance cost. There are two types of fixed cost: fixed operating and fixed finance. Fixed operating cost can be rent. Fixed finance cost can be interest. I'm just taking interest. Okay. I'm writing here. Let's say I am into a world whereby there is no taxes. Generally taxes would be there, but I'm to make things simple. I'm not complicating it. So this is my profit after tax, right? The same thing. And now what I want to find out is, I'll tell you what I want to find out. So I'm finding out degree of, there are two types of leverages: degree of operating leverage, degree of financial leverage, degree of total leverage. I know these concepts are very new for you, and in your CFA level 1 syllabus, or the students who are studying ACCA, they don't have this kind of stuff. Okay. But still I'm trying to explain you what this is. So here, degree of operating leverage, the formula is percentage change in degree of operating leverage. Because I did not take fixed fixed operating cost, then how? Okay, I'll take degree of financial leverage. Percentage change in, okay, it's not going well. Okay, let's take this fixed expenses rent. Okay, 50,000 is PBIT. Then interest we will remove 10,000. Then you get 40. This is PBT, profit before tax, or profit after tax. Let's say no taxes. Okay. So percentage change in PBIT by percentage change in sales. This is degree of operating leverage. See, you should not worry about all this. This is not very complicated and tough thing. It's a very simple thing. You have already studied about elasticity of demand. Please tell me, all of you, yes or no?
Yes, sir.
You have studied about elasticity of demand, right? What is the formula for price elasticity of demand? What is the formula for price elasticity of demand? Don't Google search. Try to answer. All this is there in your economics. Bhargav, what's the formula for price elasticity of demand? What is the concept of elasticity of demand?
Sir,
Yeah.
It's like quantity demanded and the amount supplied.
No, there's nothing like that. Yes, Bhargav.
sir,
It's very
uh,
easy, right? Tell me.
quality.
No Google search.
Yes, sir.
Taking time and searching is not good. See, that is
Yes.
what you're forgetting things. Again, you'll be studying this economics in your CFA level 1. See, very simple, boss. How demand responds to changes in price. If price changes by certain percentage, how by how much percent the demand would change? That's what you study in elasticity of demand. So the formula: price, elasticity of demand, or if I have to say responsiveness of demand with respect to changes in price. How the demand responds to changes in price. If the price is changing by X amount, by how much percentage your quantity demand is changing. That's what. So percentage change in quantity demand by percentage change in price. This is the price elasticity of demand. How your quantity demand responds to changes in price. If my price is increasing from 10 to 12, what is happening to my quantity demand? That means if I take this is as 20%, that means my price is increasing by 20%. By how much percent my demand will decrease? I have to see that. Let's say it decreases by 40%. What does it show? For a change of 20%, double the change in quantity demand, right? For a change of 20%, that means if my price is increasing by 20%, my quantity demand is decreasing by 40%. The relationship between price and demand is what? Negative. When price increases, demand decreases, right? So here we see 100% change in this is making 200% change in this. If it is increasing by 20, it is decreasing by 40. The same concept is applicable here. If your sales are changing by some X percent, by how much percent your PBIT is changing? That's what you're seeing here. Many students, they blindly mug up this concept or by heart this. Never do that. Every concept has a base. So the concept of leverage, okay, has been derived from the elasticity of demand. For your kind information, if you're interested, I can share the video of leverage concept with you right now. I know it's not there in your syllabus, but somewhere or the other, it will reflect in part 2, level 2. You're going to study that. Just a second, I'll send the videos to you. Just watch it today. Give me a sec, I'm coming. Just a second, huh? I'm giving. Are very high, but when our revenues are very low. This was there in your syllabus. I don't know why these people removed, but it's not good thing. You should be learning about these things. Check your phones. I have uh, just a second. I've just sent the video. Just check your books. Hello. Just check your phone. Sorry. Did you get this?
Yes, sir.
Yes.
Yeah. So today go through that. Just I'm giving you a small idea about this concept. Why I'm giving is to show you something that how you can take advantage of or leverage. Leverage in dictionary meaning is advantage. You many a times when you see cricket match, you see commentators using this word very usually. The home team has the leverage of home conditions. The home team can take the leverage of pitch conditions because they know the pitch very properly, batting pitch, right? So leverage means advantage. How you can take advantage of your fixed cost, we are seeing in this particular question. See, now what I'm doing is I'm just trying to find out the degree of operating leverage. Okay, and I'm going to prove you how you can take advantage of your degree of operating leverage. So let's say I'm increasing my revenue by 200%. Okay, that means first I was 100%, sorry, extremely sorry. I was producing 100 units. Now I'm producing 200 units. I'll make it 2 lakhs. And you know, as my sales or revenue increases, my variable cost also increases by the same percentage or by the same level, because variable cost follows the revenue. Okay, variable cost is the cost which varies with the changes in activity level. So now the activity has doubled, right? So now you see the variable cost also has doubled. So 120 is my contribution. Contribution is not something which is very tough thing to remember. Excess of revenue over variable cost is contribution. See, now you are going to see some drastic thing or a very crucial thing. See, variable cost has increased, right? What about the fixed cost? Is it going to increase?
Constant.
No, right? So the fixed cost is going to be constant here. Now what you are observing? You're observing that as the activity levels have got doubled. Yes. What advantage we are seeing here? We are seeing that our contribution has also doubled. Our fixed cost is same because it is not going to change. And here also our fixed cost is changed. And you see our profit after tax is very high right now. Correct? Because of this particular element called fixed cost. Now we are going to see the leverage. But before that, I'm going to take one more figure here. So I'm going to reduce the level to 50%. Okay. I don't have space here. So I'm putting here 50 units. Now with 50 units, my revenue is going to decrease. It's going to become 50, right? And what's going to happen? My variable cost is also going to get halved. 20. My contribution is 30. My fixed cost is 10. 20. My fixed cost is 10. My profit is 10. What are you observing right now? Please tell me. You are observing that the advantage of the fixed cost, that is 10,000 and 10,000, was only possible to be taken when the number of units doubled or the activity level has doubled. But when the activity level has halved, can you take the advantage of this fixed cost to maximum extent? No, because
No.
your profit after tax is very less right now. And maybe if further down I go, if I reduce my activity levels to 60%, that means instead of taking 50 units, this is half, right? Right? 100 units, the half of 100 units is what? 50 units. Correct? If I dip this to more 60 or 70%, I may only make 30 units. In that case, will I get profit also? No. Why will I not get profit? Because my revenue will be less than my cost. Am I right? How? See, I will dip this to 70%. So 30 units I'm making. So my revenue will be how much? 30,000. My variable cost, you have to take 30,000 of everything. 30,000 of this is how much? 12,000, right? How much I will get? 18,000. How much is my fixed cost? 10. How much am I getting? 8. How much is my fixed cost? 10. I'm getting a loss of 2,000. Correct or wrong? Please tell me. All of you in chorus, yes or no?
Yes, sir.
Yes,
Yeah.
sir.
So I cannot take advantage of my fixed cost if my revenues are dipping. I can take the advantage of fixed cost only if my revenues are high, or it is doubled, or if it is tripled, if it is 4 times, if it is 5 times. Excellent. I may get very high profits. And now let's put in the formula and see. Percentage change in PBIT by percentage change in sales. I'm giving you the interpretation of this. Percentage change in PBIT. So previously my PBIT was how much? 50,000. Now it is 1,10,000. So 1,10,000. This is the current year figure minus previous year figure divided by previous year figure. The formula for percentage change. And here this is change in PBIT. I am going to see the change in sales. Change in sales is 100% because right now it's 1 lakh minus 50 by previously it was how much? 2 lakh and 1 lakh. Sorry. 2 lakh minus 1 lakh divided by 1 lakh. Okay. So 110 minus 50 is 60. 60,000 divided by 50,000 whole divided by 1 lakh by 1 lakh. This is 100%. So 60 by 50 I think is 110% if I am not wrong. 1.2. That means 120%. Okay, 120 by 100. So what I can conclude is if my sales are increasing by 100%, my PBIT is increasing by 120%. Come on, tell me yes or no.
Yes, sir.
So it is a very high change or very low change? High change. Why the changes are very high? Why with the increase of 100% in revenue, I am able to generate 120% increment in my PBIT because of fixed charges, because of the fixed operating cost. Am I right or wrong?
Yes, sir.
Yeah, because what has happened is irrespective of increment in my activity level, my fixed cost has remained the same. And that has given me a very high percentage change in PBIT. This advantage can only be taken if at all my sales levels are doubled or my activity level has been doubled. But if I half my activity level, you see what's going to happen. So now here 100 units and here 50. I know that my activity level has decreased by 50%. So I'll write it here. How will I write it? See. So percentage change in PBIT by percentage change in sales. So the current year figure is 50,000 minus 1 lakh divided by 1 lakh. Is it right or wrong? Correct, right? My sales has decreased by 50%. Isn't it so?
Yeah.
Isn't it so? See, what is the formula for percentage change? Current year figure minus previous year figure by previous year figure, right? Now, in the numerator. In the numerator, where is that? Current year figure minus previous year figure. Okay, if I take 50 units backside, this becomes the current year figure. Current year figure minus previous year figure by previous year. Just a second. From 100. Okay, it was 100, right? So it has decreased by, so 50 minus 1 lakh is 50. 50 by 100 is 50. 50% decrease. And there, how much decrease? The decrease will be way higher because I was not able to take the leverage or the advantage of fixed expenses. See, now here it was 150. Now here what will happen? PBIT 50 and 20, right? Correct. Now see, current year 50 minus current year is 20. 20 minus 50 by 20. See, so I'm getting 60% dip here, 50%. So if my sales has decreased by 50%, right? My PBIT is decreasing by how much percent? Come on, tell me. How much percent? I'm asking the answer. Hello?
60%.
60%. So what does it show? It shows that a 50% decline in sales is going to decrease your PBIT by 60%. Why? Because when the sales are decreasing, you are not able to take advantage of your fixed expenses. You're not able to take the leverage of your fixed expenses. See how when my particular sales level have declined, that means from 1 lakh units, now I'm selling 1 lakh. From the sale of $1 lakh, I'm making the sales of $50,000. There's a dip of 50% sales, right? That's very clearly and evidently seen. And what is my PBIT? My PBIT has also decreased by 60%. That's very clearly seen. Why? Because here when my sales increased, my contribution was also very high and my fixed cost seemed to be like peanuts here, because when compared to 120,000, 10,000 is a very small amount. When it is three, let's say instead of 120, if it is 2 lakhs, 10,000 will seem to be a very small amount. If it is 5 lakhs, even very small. 10 lakhs, very, very small. So whenever the sales are increasing, I'm able to take advantage. But when the sales have declined, you see this particular 10,000 in this particular 30,000 seems to be a very higher amount. It really seems to be not sorry. This 20,000, right? 20,000, yeah. PBIT, yeah. So it was previously the PBIT was 50, and here, yeah. See, I'm recovering my fixed expenses, right? Here, when I see that my fixed expenses are 10,000, it is a very big burden. It seemed to be here. Why? Because my contribution amount is very small. So 10,000 and 30,000 is a very big amount to recover, but 10,000 and 1,20,000 is very small amount to recover. Okay, so that is the difference. So here I'm not able to take leverage of my fixed cost. Why? Because my sales are not high. My sales have dipped. I can only take advantage of fixed cost when my sales are high. My revenues are high. That's what we proved. So that's the reason why increment of 100 decline in the sales by 50% has made my like PBIT to decrease by 60%. That's what I have seen here. Okay. So with high sales, if the sales are increasing by 100%, my PBIT was increasing by 110%. My sales are decreasing by 50%, my PBIT is decreasing by 60%. So more the decline leads to very high decline. The increment leads to very high increment. Understood? That's what. That is what I wanted to explain you in case of debt to equity ratio. Debt to a certain limit is very good, but debt beyond a certain limit makes things very complicated and worse in the business and makes the business a risky investment for investors as well. So investors would always want to invest in a company which maintains a balance of proper debt to equity. Okay. So increase and decrease in this ratio suggests a greater or lesser reliance on debt as a source of financing. As we have seen, if the debt is high, here I have put 2 lakh as my debt and my equity is 1 lakh. I can see my debt is twice the amount of my equity. Somewhat acceptable. It goes 4 times, not acceptable. I already explained you right now. Debt beyond a certain limit is not good. And you can take advantage of debt finance. That also I have explained you right now. So since advantage of debt finance can be taken, can be exploited, people go for debt finance, and that concept also I have explained you right now. Okay, with the help of leverage concept. Next is debt to capital. What do you mean by debt to capital? What is the proportion of debt in the total capital of the business? What is the proportion of debt in the total capital of the business? Let's say the total capital is 10 lakhs and debt is 5 lakhs. So 50% debt. in the total capital, that shows 50% is equity. 1:1 is a balanced ratio. If debt is 60%, 70%, 80%, then definitely the business has a lot of risk and more reliance on debt. Now, debt to assets ratio. Let's say in my balance sheet, my assets are of 10 lakhs. Okay. And equity is 5 lakhs and debt is 5 lakhs. Okay. Debt and equity. What does it show? If I take 5 lakhs of debt and 10 lakhs of assets, 50% of my assets are financed by what? Debt. Then 50% will be financed by equity. Come on, tell me yes or no.
Yes,
Yes,
sir.
sir.
Yeah, and again one more thing. If at all the ratio is like 7 lakhs by 10 lakhs, that means my debt is 7 lakhs and my total assets are 10 lakhs. That means 70% of total assets have been funded by debt finance. And again, that again is dangerous. Debt beyond a certain limit is very dangerous. Always try to maintain a debt to equity ratio of 50-50 or 1:1. That's it. I'm saying it is dangerous, but I'm not saying that you should not invest in such kind of companies. There are few people who always would like to invest in very risky companies because they want very higher returns. Now, financial leverage. So financial leverage ratio, also called as equity multiplier. Okay. In certain other textbooks, what does it show? Average total assets by average total equity. Okay. So another measure that is used as an indicator of companies' use of debt financing is financial leverage ratio. Very simply, if my total assets are 10 lakhs, my equity is 5 lakhs. It shows 50% of my assets are funded by equity. That means 50% usage of debt. That's what this ratio tells, how much the company is reliant on debt finance. Okay. And again, if the debt finance increases, it's again risky for the entire business. Now, so see, all of these ratios, what we are seeing are having a very similar concept. Every ratio wants to caution you regarding the usage of debt finance. I know people will be very much tempting. Companies are really, attracted towards debt finance because it's easily available. Okay. You should not be, struggling that much, raising the finance in form of equity, because if you want to raise your finance in form of equity, then you have to do a lot of paperwork. Same applies for debt, but in case of equity, you have to pull the investors, attract the investors. You have to register your list your company, and like lot of disclosures would be there. Everything you have to disclose. But in case of debt finance, you have to just approach a bank and get your loans. That's it. It's easily available and cheaper source of finance. Unlike the equity holders, company has to pay more to the equity holders when compared to the interest what they pay to bank, because at the end of the day, the ones who are taking the maximum risk is the owners of the business, the investors. Interest coverage ratio. What does this ratio tell? This ratio tells what is the capacity of company to make the fixed interest payments, and this ratio is more often checked by the debt holders of the company. I can say the lenders of the company who have lent money to company by buying the bonds of the company. Okay. So this ratio is maximum checked by the lenders. Now don't see, creditors and lenders are different. Creditors are suppliers. Okay. They are related to merchandise. Okay. But lenders are the ones who lend money. Lenders can be bank or can be public, right? Now, public can buy the bonds, the security of the company, and lend money. Banks can take the security of the company as collateral, that is property documents as collateral, and give the loans. Now, the formula for this is earning before interest and tax by fixed interest payments. Let's say your PBIT or EBIT is 1 lakh and your fixed interest payments are 10,000. So what is the ratio? The interest coverage ratio is 10 times. That shows company has 10 times the capacity to make the fixed interest payments. That means company has enough earnings or operating income to make the fixed interest payments. So my question to you is, why I didn't take EBT, Bhargav? Instead of EBT, why I took EBIT? Yes, Bhargav. Bhargav, are you active?
Yes, sir.
Yeah, can you give me the answer for this? Why PBIT or EBIT? Why not EBT?
So
You have covered already in CBSE, right? Very simple. Hello.
yes, sir.
Yeah, please answer. Isha, you try to answer. I'm asking a question. Why are you taking EBIT instead of EBT?
So I think that holds the interest rate.
Sorry.
That holds the interest.
See, you people have really like have like idea of the formulas, but the deeper concept is very important to be remembered, because in examination they may twist the questions and they may ask certain questions which you may not be able to answer. The reason why we take EBIT instead of EBT is any company can pay the interest to the bond holders only from their operating income, which is EBIT. From your operations, whatever you have earned, from that only you are going to pay your fixed charges, fixed interest charges, right? That is from EBIT. If you pay I, that is interest, you get EBT. As simple as that. Why are you not able to answer this one? Hello?
Yes, sir.
Yes, Bhargav.
Yes, sir. Understood.
So that's what it is very important to once have a refresher of this. Okay.
Yes, sir.
Next point. Let's go for the next one. Just a second. Just a second. Okay. Actually, according to me, this ratio is one of the most, like underrated ones, and in fact should also be, because it doesn't make sense why this ratio they have kind of been using this. So here, one more thing I would like to give the interpretation to you. The higher the ratio, the better capacity of the company to make the fixed interest payment. The lower the ratio, the less the capacity of the company to make the fixed interest payments. Let's say if the ratio is 6, company has only 6 times the capacity to pay the fixed interest payments. That's not good, right? Now, they should have greater capacity, and that will give more that will give more confidence to the bondholders regarding their future fixed interest payments. Now, fixed debt to EBITDA. What is this EBITDA? Earning before interest and tax and depreciation and amortization. Depreciation is for fixed assets or tangible assets. Amortization is for intangible assets, right? So another indicator of company's ability to meet its obligation is fixed charge coverage ratio. This also I'll just cover up, but let's see what is the next ratio saying us. So interest coverage ratio we have discussed. The lower this ratio, the more likely it is that firm will have difficulty meeting its debt payments. Okay. Because depreciation and amortization are not cash expenses, another ratio that reflects a firm's ability to meet its debt obligations is debt to EBITDA. The ratio indicates how long it would take to repay current total debt from approximation of operating cash flow. So here the focus is not on earning before interest and tax. The focus is on operate. Just a second, I'll put the terminology, you'll understand. Here the focus is on operating cash flow rather than operating profit. If I have to consider operating profit, it will be EBIT. If I have to consider operating cash flows, it will be EBITDA, because depreciation and amortization in fact are shown as expenses in statement of profit or loss, but they aren't cash expenses. Nothing is going from your hands in this. So when you make statement of cash flows, that means cash flow statements, when you make, you take PBI, you take PBT, not sorry, PAT, sorry. You start your cash flow statement from PAT or net profit, and to that you add depreciation and amortization. Please tell me yes or no if you remember cash flow statements, all of you.
Yes, sir.
Yeah. So why do you add these two? Because these are non-cash expenses, and your agenda or motive here is to find out the cash flow from operating activities or operations. So here we have taken operating cash flow. So the point here is we are seeing whatever debts we have. Let's say we have a debt of 1 lakh and we have operating cash flows of like 10,000. Okay. Okay. That means we have 1/10 of this particular debt. That means here like, okay, let's say I'm not going in this way. Let's say I'm going in this way. It's like, because depreciation and amortization are big amounts. So let's say my debt is 50,000 and my operating cash flows are 1 lakh. So can I easily repay my debts with this? Come on, tell me.
Sir, it's difficult.
Yes, sir.
What? My debt is 50,000. My operating cash flows are 1 lakh. Can I easily pay my debt?
Yes.
That's what. I have 100% more cash than my debts. That's what. Or my debts are 50% of my operating cash flows. That's great, right? Now, one more ratio, fixed charge coverage ratio. So in this, what they have done extra is they have just added the lease payments. So already we had EBIT, whereby interest was fixed expense. Now they have added one more kind of fixed expenditure, that is lease payments. And in denominator also they have added interest payments with lease payments. The concept is same. How much earnings I have, so that I can easily, what can I do? Make my fixed interest payments, fixed interest and lease payments. So here I'm taking earning before interest, tax and lease payments divided by interest and lease payments. So if I have 1 lakh of this and 10,000 or 20,000 collectively of this, so I have 5 times the capacity to repay this. Okay. That is what is very important for whom? For the debt, for the lenders. Those are nothing but the people who have purchased the bonds of the company, and also the lessors. Who are lessors? Who give the property on lease basis to the company. Are you understanding? These are
Yes,
people
sir.
who lease out. These are people who lease out the property to the company and collect the lease rentals, right? Now, see, this profit margins are done. Everything is done. Yeah, this one is left over. ROA, return on assets. See, return on assets is nothing but, what is average total assets, right? Opening balance plus closing balance divided by 2. Just a second. So let's say your average total assets are $100,000 and your net income is $10,000. For an investment of $1, you have earned a profit of 10 cents. Investment in what? Investment in assets. That means you have bought machinery, you have bought land, you have bought building. So you've invested $100,000 for that and you made a profit of $10,000. So for investment of $1 in assets, I made 10 cents of profits. What I want to see here is whether previous year I earned more or less. In previous year for $1 I earned 8 cents. This year for $1 I have made 10 cents. This is a good year for me. Okay, so what I'll do is I'll stop here today. So because lot of ratios what we have done today are very critical and crucial ratios. Tomorrow we'll cover up from here. And tomorrow we will do questions because this is the second chapter in ratios and this will also be done by tomorrow. Okay. No, DuPont is also there. Let's say if I'm not going tomorrow to the academy, what time you will be available, Bhargav, tomorrow?
Sir, I'll be available like after 4 only, sir. I have college.
Okay, no problem because I want to finish this ratios. Ratios are 2 chapters here and ratios is a big chapter in financial analysis. There are 2 chapters back to back which can be covered up and also ratios will be seen in almost all the chapters because if whatever the chapters you're covering in financial analysis, everywhere due to certain changes here and there, how the ratios are going to change, you are going to check that or see that. So almost everywhere you're going to get exposed to this. This chapter is done, part 1, and this particular part 2 is going on. Okay, so we have already started. Tomorrow I'll wind up this one. Ratios. Okay, so 4 o'clock you're saying, right?
Yes,
4
sir.
o'clock. I will be okay. I will check if I'm coming by 6 p.m. also. I'll try to start by 6:30 early tomorrow. That's all right.
Okay.
Hello.
Yes.
Yeah, because I want to put a full stop to this chapter by tomorrow at any cost. Right? Sure. Okay. Thank you all of you.
Thank you, sir.
Thank you. Thank you.